Okay, let's talk about debt instruments. So let's talk about the fact that you are really whether you're buying bonds, and what I mean when I say you're buying bonds, you are lending money to companies. And so the argument really here is that that normally, I mean, the fair value through profit or loss is your first sort of natural call where movements are going straight to profit or loss. But of course, there are 2 points that we need to consider. If we're talking about a sort of a loan where you have bought debt and you expect to hold that loan for the entire period, right? So, for example, the same way the other party who borrows money recognizes the effective interest rate and pays back, and you're literally the opposite of that transaction, like everything we talked about a financial liability, then it wouldn't make sense to recognize it through profit or loss. It would make sense to recognize it over the life of the loan, if you like. So there's two things we need to test for, if you like. The first position is called the amortized cost, which is, again, passing this test of whether or not you are truly receiving regular contractual payments towards principal and interest, and then you will receive the full amount at the end of the life of that loan. So this is referred to as the business model test, where the objective of the entity's business model is to hold the financial asset to collect the contractual cash flows. The plan is not to sell the instrument prior to its contractual maturity to realize its fair value changes. And the contractual cash flow characteristics test says the contractual terms of the financial asset gives rise also on these specified dates or regular dates you receive this amount of money, and if you like, payments of the instrument and interest on the outstanding amount. So it literally the flip side of how the other person is paying, you're receiving these fixed amounts, these coupon rates, as was planned or agreed at the beginning. So if a debt instrument is held at amortized costs, the interest income will be taken to the statement of profit or loss, and the year-end asset value is shown in the statement of financial position. So I've said here, the working for this is similar to the table used in a finance lease calculation or the loan calculation, but just the reverse, where you are the one receiving money. The second test that must be passed, and that's really the first thing. So really, it's the same scenario where you will, of course, recognize the you've lent out money of, say, 10 million, bank 10 million. Maybe you had to pay some transaction costs. You can capitalize that as well. Maybe, I don't know, maybe that's 500,000. So that would be 0.5, and then you have 0.5. And then you would have this effective interest rate accrue. So you have finance income. I'm just going to call it, say, 1 million, and you receive 1 million. And you receive in the bank money to offset this, right? Like you're receiving the cash payments, the coupon rates. It might be a deeply discounted bond where you're only going to get, say, 800,000. 800. So that's like an 8%. It doesn't matter. As 0.8. I'm just key point. The point is that it's a percentage of the 10 million. I don't really want to pick, but key point here is that you are receiving this funding, and that money, that cash coupon, is reducing the asset owed to you. Basically, just imagine you're receiving money to a trade receivable. Debit bank can credit this asset, and that's kind of bringing that down. And that's how we deal with that. So you would hold this like this over its life, right? You would hold this over its life. Then your other position, of course, is called the fair value through other comprehensive income. So the intention here, again, is to hold this to its fruition, its completion. But if an opportunity comes up, you'd be willing to buy for a higher return. So let me give a very classic example. Imagine you lend someone £10 million, bank 10 million. Right? And you're currently charging them. I mean, there's a number of ways of thinking about this. You've got a coupon rate where they're paying you, I don't know, say $1 million a year. Let's just say that's what they're paying you, $1 million a year, and the effective interest rate is $1 million. Say, for example, an opportunity comes up where you could, if you like, literally sell this and invest this in another asset where you are going to get, if you like, whatever, you were going to get, say, $2 million a year. You would sell this to someone else. You would get rid of this asset. So someone else, you literally dispose of it, 10 million, and it's no longer with you. And someone would pay you 10 million, and you would, if you like, bank 10 million, and you would now invest that 10 million in a new asset where you were, like, say, someone was willing to even give you 2 million every single year as interest. So the key point here is that this isn't typically your plan. You're not into trade. It might be the fact that you're concerned that you might not get the money from this person on time, so you're worried. So you might think, no, I need to let go of it so I don't get into trouble. So I still have something here. So you might sell that asset to get a better asset. The key point here is that what we're saying here is, as opposed to totally restricting you or forcing you to hold the loan till the end of maturity, if a good opportunity comes in, you know what? You can recognize this through fair value through other comprehensive income. So what does that mean? Every year you value it. You're doing it amortized because that's the plan, effective interest, cash payment. But every year, do a revaluation and to fair value, and any gains or losses take to other comprehensive income. No problem, right? And just keep it. Don't let it hit your income statement because that's the concern. And if an opportunity comes for you to buy and sell it, no problem. You dispose of it, and then other comprehensive income can then be recycled. Whatever gain and loss there can be recycled into the income statement then, if you like. So they're telling you you can hold on. You don't have to suffer any shocks in your. You don't have to suffer any shocks in your income statement just because you wish to sell. Because really, there are strict rules over your treatment of these assets. So again, the same sort of test for amortized. It's still really amortized, but we're just saying that you have a get out clause to be able to sell the asset if something better comes along. And that's what we're talking about here. And as well, of course, you're holding it for the long term. Just think amortized costing. The asset is initially recognized at fair value plus transaction costs. And we treat everything, like I say, like amortized. Interest income is calculated using the effective rate of interest. So you treat everything as though you're dealing with amortized, just that we're also recognizing fair value at the end. And just those movements are being put through to the income statement. Sorry, are being put through to the other statement of other comprehensive income. Again, you can see here, I've written here, fair value through other comprehensive income, as normal, as amortized, but at the reporting date, the asset will be revalued to fair value with a gain or loss being recognized in OCI, and this will be reclassified as to profit or loss on the disposal of the asset. And of course, the last one I seem to have just not talked about it here, but the fair value through profit or loss. So here's a scenario where you're literally holding the asset, and if something you're clear about the fact that I'm holding this loan, I trade in loans, I buy and sell loans, I'm happy to sell this loan note if a better loan note comes up. That's my business. So any gains and losses will go straight to profit or loss. So you recognize it very clearly as fair value through profit or loss. So yeah, that kind of is really the point. And I think it's just, of course, working through questions and having a go. I think there's a very good TYU there for you to work through. Just on derecognition, just a final point. Once the asset has expired or once the transaction is complete, you shouldn't be recognizing it anymore. Literally, once the obligation is discharged, let it go. That's the key point with derecognition. It shouldn't be showing on your statement of financial position. Very quickly, this business of factoring of receivables, you've come across it before, in that let's put it this way, keep it very simple. If you have a trade receivable of 10 million, right, and I'm just going to say it's one big receivable, for example, and you need the money urgently, you can sell this receivable to a factor. You can sell the piece of paper. Basically, you sell the invoice, and they will give you some money towards it, and it's no longer your responsibility. Imagine you sold it for 8 million. You would have 8 million here in the bank, right? And you will have a loss, if you like, of 2 million, loss of 2 million, and the asset's gone, right? It's gone. You've sold it. You've disposed of it, literally gone. So you have your bank account 8 million. So typically, if you're trying to do this, you're always going to get less than the actual original value, right, of the paper, but because that's what they've done for you. This is what factoring companies do, and this is called factoring without recourse. Without recourse. This is what this is really saying, right? You have no more responsibility over that loan. But you have scenarios where sometimes a factoring company will say to you, "Listen, we'll give you money. We will chase up the debt for you, but you are still ultimately responsible for your debt. If we can't get the debt, we will return all. Basically, when we chase up the debt, whatever we get, we will send to you. Whatever we don't get, we will send back to you. So whatever debt we were able to claw back, we'll send to you. We'll send that money to you, and whatever debt we can't claw back, we will send you the balance, and you will have to keep chasing them up. But in the meantime, we will give you a certain amount of money. That amount of money they give you really is a loan. So really and truly, you are still very much in control of the trade receivable asset, and so you should not derecognize the asset, but literally recognize the receipt from the factoring company as a loan. So if they gave you, like, I don't know, 5 million or something, you would literally recognize, if you like, just like you would any loan, you would recognize that loan via recognizing bank money coming in the bank, and you would recognize a loan with your trade receivable invoice as collateral, really, in effect. Really, and that brings us to the end of this topic. I would say throw yourselves into the CYUs, and that will expose you. We talked about this in class, but that will expose you to some of those questions on dealing with financial assets. Key point again being, I'll start from the top. Financial assets. We have two typically financial assets: equity, and we have debt. And when I say debt, that could be loans or bonds. Equity, pretty straight, typically fair value through profit or loss, typically listed companies, like 10% and under 20%, because otherwise we'd have to do some associate accounting or consolidated. Or you have fair value through other comprehensive income. So we're dealing with private limited companies, and so you intend to hold these shares for the long term, and so any profit or loss moves to this other comprehensive income and doesn't affect your income statement. With debt, we have sort of three options: your fair value through profit or loss, where you're trading in these things, any movement or change in the value goes straight to the income statement, done. Or you intend on holding it till the end, amortized, calculated effective interest rate, received the money, balance brought down. Effective interest rate, received the money, balance brought down. Or you want the option, it's still amortized, but you want the option to be able to sell it if a better deal comes up. And this is when we recognize it through fair value through other comprehensive income, recognizing profits and losses in other comprehensive income, similar to this, and if you like. But here, when we now sell the asset, we recognize the gains and losses in the income statement, as opposed to here, where when we recognize the profits for equity, it goes straight to retained earnings. We don't put the profits through the income statement. Slight nuance, but an important point. Okay, great stuff. And yeah, enjoy.